Okay. Good evening, you amazing human beings. I know it says pounds for breakfast, but it is actually dollars for lunch. Guys, welcome to this evening's Trade-A-Thon. We are still in dollar territory, so again, it will still be dollars for lunch. Guys, I hope you enjoyed this afternoon strategy. Again, it was a little bit of an update to the strategy as we go deeper and deeper now. A lot of these strategies have been shared freely, but this will not be shared freely all too often, right? Again, these are going to start to become the more closed classes where you do need to have $1,000 or more in your account to dive deeper. We've laid down the foundations there. Zia saying dollars for dessert. We've laid down the foundations in a free and public environment, but now it's time to go deeper as we dive further and further into dissecting the strategy, into looking at certain days, certain times of the day, and how we can obviously benefit from that. So I've got a ton of screenshots from all of you, and listen, if I don't share your screenshot in the group, doesn't mean I haven't seen it. It's just I've got to pick and choose what messages I can open or what I can respond to. So if you submitted your screenshots of profits in that massive US30 sell, just know that I appreciate it, know that I will see it, whether it's today or tomorrow, wherever it may end up being. So again, we are Gawain saying he's in a buy. I'm not 100% sure about that one. We're still all in sells. But listen, just a word of caution, the internet is not all too great this evening. The IT team swapped out SIM cards and networks, but as we got into the office, it doesn't seem it's holding up all too well. We're getting very low bandwidth, so please just continue to bear with us. If we do get cut off, which it does seem, I'm watching the feedback on my side, and it's looking extremely slow with a bunch of issues. So if we get disconnected, worst case scenario, I will restart the stream. No matter what I've got to do, I will make sure we get live and back online. So if it does get disconnected and the stream ends, it might expire, or this link may expire. I will then reshare a new link into the GlobalX 360 Live TV Telegram channel. Okay, so just let me know, guys, is it looking okay? I'm watching it back in very low resolution. Just let me know how it's looking and how it's going. It's super frustrating, I know. I just want to come, I want to trade with you guys. I don't want technical issues, but yes, this is unfortunately the world we live in, with internet issues and ESCOM and everything else in between. But no one else to blame. We need to be prepared, we need to be ready. Okay, so everyone's saying seems fine, coming through okay. So I'm just going to have faith this evening. My team and this beautiful woman here next to me will wave her arms, everything breaks. So if she doesn't wave her arms and scream or make a weird face, then I know we are still good. Is everything fine there? Okay, good stuff. She's moving around. Not sure what. Are you okay? Yeah, the team. I think people are going to start asking how they want to see you. Heinrich, how's things going from Durban? Okay, beautiful. But anyway, we're not yet talking about internet issues. We are here to trade. That's what it is all about. Okay, guys. So it's really struggling from an internet perspective. Web pages are struggling to load, right? So I don't even know how the stream is working, but we're going to try and figure it out together. So what are we doing this evening? So for most of you have traded some sort of interest rate with us in the past. If you have traded the interest rate decision, you've traded a Powell speech with us, just vote number 1, put your hands up there and just say essentially number 1 means you've been with us before, you know how this works. And vote number 2 if you've never traded an interest rate decision, if you've never traded a Powell meeting or Powell speech before, just so we can understand how deep to go and what sort of level of people we have in the groups today. So I can see a ton of ones there. I can see Lee saying never traded yet before. Maybe Ruby Soleil's on your streaming program. It helps. Yeah, unfortunately, it's not streaming. The streaming program, the bandwidth that it sends out is consistent, whether it's just my face or a whole bunch of green screen. It's exactly the same. Let's see. I'm getting a bunch of 2s, a bunch of 1s. Okay, so what we're going to do is we're going to cover the basics. We're going to talk about it in general. So let's rewind a little bit. So I can see a bunch of 2s in the house. If you're brand new to the channel, brand new, never been here before, starting for the very first time, maybe just also let me know, put a number 3 for us, just so I know that you're brand new, joining us for the first time, and I know then, yeah, just drop a number 3 if you're brand new to the channel in addition to that, just so I know how far to go. Okay, there we go. KZN is a number 3. Anke is a number 3. Beautiful. Welcome to the channel, guys. Listen, if you haven't yet subscribed, if you're voting number 3 and you haven't yet subscribed, I'm looking at you with suspicious eyes, right? Just Travel number 3, Vernon Mudley number 3. Guys, smash that subscribe button. You know what to do. It is that time, right? We're calling you out. I can see your names, so you have to vote. If you voted number 3, you got to smash that subscribe button just so we can go a little bit deeper with you all this evening rather. Okay. Beautiful stuff. All right, guys. So listen, first things first is we're going to be jumping into the federal interest rate decision right now. This is probably one of the biggest keys when it comes to, the economy, right? Interest rate decision sets the base interest rate for all credit, for all debts, right? For the US economy. And in most cases, because the dollar is so big, it sets the tone for the rest of the world, right? Now, I'm going to show you guys a chart really quickly, and this is going to be the best explanation in breaking down, essentially how interest rate works and why economies use it and what they use it for, right? So I'm going to show you 2 charts. The first chart is essentially having a look at when recessions have hit, what they've had to do in order to curb this. And I'll explain this a little bit deeper as we go. So I just want to show you guys this chart really quickly. Okay, so behind me is what is the dollar index. The dollar index is this blue level here. Okay, and the gray, which you see behind me, which I'm just going to move my head away for a second. Yeah, we have the 2007-2008 housing crisis, and over there in this little gray line here, we have the coronavirus scare, pandemic, whatever you want to call it, right? So what we need to understand is that when an economy is in a time of need, right? Meaning there's any sort of crisis, there's any sort of panic, there's any sort of struggle with the economy, the Federal Reserve lowers interest rates, and they lower interest rates to make it easier for the general population, the public, to acquire credit at a low interest rate. It means exactly what it sounds like, right? So lowering interest rates incentivizes, and it basically creates an incentive for the economy to loan more money, puts more money into circulation, and allows more buying and spending activity, ultimately boosting the economy. If more people have access to funds and they're actively spending that money into businesses, into different areas in the economy, they're boosting and bolstering the economy. So as we saw with the coronavirus pandemic or the 2007-2008 housing crisis, we can see over here the dollar index in terms of its actual dollar rate, right? The dollar index performed, Now, why would the dollar index, this blue level here is the dollar index, why would the dollar index perform well during the time of recession, right? Or time of bad economic activity? And the same thing over here. Why would over the coronavirus, why would the dollar perform over that? We need to switch over to the next chart, which is exactly the same thing. And I'm just going to isolate just that period that we were busy looking at now. Let's go. And there we go, 2007, 2008. So here's the same chart. I'm going to switch back. Here's the dollar index. Here's the same chart. The only difference is this reflects the interest rate percentage. So we can see at times of crisis, right, 2007, 2008, the Federal Reserve started to drop interest rates, right, all the way from a base rate of 5.26% all the way down to almost zero. And in some cases, in some places, it actually almost went into a negative, meaning they dropped interest rates to the point where it almost became free. It was almost cheaper to use the bank's money than it would be to use your own money. Okay. And they do this to stimulate the economy. Now, they would leave interest rates at a low point for a period of time, but once the economy is overstimulated, they need to then start raising interest rates once again. And why do they raise interest rates once again? Because overstimulation of an economy, too much growth, too fast, causes inflation. Now, inflation is the term that's been thrown around quite a bit, and everyone's, oh no, inflation, oh no. What does this mean? It basically just means that, the buying power of any one currency starts to diminish. Where, a bottle of milk costs $10, it then starts to cost 15, then 20, then 30. And that is why you'll see anytime they compare old prices in the 1970s, 1980s, they say, $100,000 back then is basically like $1 million now because of inflation. That's basically what inflation is, right? And so in order to curb that, they need to reduce the amount of economic activity. They need to contract the economy or the amount of free money in circulation. And that is why interest rates start to increase, right? And they slowly start to taper interest rates up to ultimately get to an interest rate goal. Now, a lot of people sometimes get confused and say, well, that's a very low interest rate. That is the base interest rates. Most Federal Reserves or governments have got what's called a base interest rate. And then the Reserve will essentially set that rate, and then banks and private institutions will have some sort of markup on that, usually around about the 3% range, right? South Africa is no exception, works exactly the same here. So interest rates will be increased to essentially curb inflation. And this is what we saw in 2016, 2018, 2016 to 2019. In 2020, the coronavirus and the pandemic hit, interest rates were dropped once again. Now, where do we sit right now? Well, we sit in that curve of raising interest rates. Why? To curb inflation, right? The whole world is worried about inflation. The economies are expanding. Everything's going well, but they're worried about inflation and worried about, inflation running away. Well, then why is the fear of recession? The fear of recession is that if you don't if you don't raise interest rates, right, and stop inflation, right, the worry there is that inflation will essentially destroy local currency. But in doing that, in tightening the economy, you could tighten the economy to the point where it enters a recession, to the point where you over-strangle, over-tighten an economy. And that's where the word recession comes from. It's a correction of a bull market. So when we talk about Fibonacci, when we talk about, there's a bull impulse and it has to retrace, economies work in the same way, right? Your lifespan, your highs and your lows in life, these are all just ebbs and flows, impulses and corrections, and economies have the exact same thing. But raising interest rates too hard can cause too big of a crash, which could cause a recession. And so that is where you're going to hear a lot tonight about the term soft landing, because there's no doubt that the US economy is entering a state of recession. The big debate is, with these very aggressive interest rates that we've seen, will the economy recover and have a soft landing into recession, or will it be a hard landing? You're going to hear those two terms. Now, the importance of tonight is that if we go back into the past interest rates, we started off at a 0.25, meaning 25 basis points, which is 0.25%. And that got ramped up to half a percent, which is 50 basis points. And then it hit an unprecedented, never seen before, full 75 points, which is 0.75%. 8%, right? And that has started to come down now. Now, what's the significance of the coming down, and how does this affect the stock markets? Well, historically, if we go back to all other recessions, every time we've seen interest rates hiking, right, we've generally seen the stock market perform quite well. We've seen the dollar perform badly. What is curious about this particular instance, or this particular season between 2020 and where we are now, is that all of the interest rates that we've seen has caused a rally on the dollar. The dollar has outperformed every other currency around the world. We saw dollar parities with euro, with the pound, unprecedented, never seen before, whilst the stock market has suffered. To give you a better indication of what this looks like, I'm going to draw to this chart. And a lot of the times when we speak about this whilst we're trading, we're simply, touching on this, but I really want you to understand this, because it'll essentially give you the significance of where we are right now and what's busy happening in the world and what's busy happening in the market. So behind me, we have the dollar index. And again, apologies on the internet. And essentially what we see here right behind me is, and I'm going to maybe just go to a daily time frame. It'll make it a bit clearer for everybody. Internet is extremely bad. I'm not 100% sure I'm going to be able to trade this evening, but have a look here, right? This is essentially 2020, right? Middle to the end of 2020. And look at how the dollar index has performed, right? The dollar index has absolutely blazed through the end of 2021 and dominated 2020, right? But the second we move into, right, 2022, we start to see the dollar index fall off. Now, what has changed at 2022? Well, at the end of 2022, this is where interest rates stopped hiking as aggressively, stopped moving from 75 basis points to 50 basis points. So then you ask yourself, what's the correlation of an interest rate hike versus a decline? What's the effect on the dollar, the euro, and the pound? And again, like I said, in past recessions, interest rate hikes actually meant a weaker dollar and meant stock markets benefited from this. They benefited from this contraction in the economy. They've just always performed extremely well. The curious thing about the one we're in at the moment is that the interest rate hikes positively affected the dollar and negatively affected the stock market. So now, why do I say negatively affected the stock market? Well, let's do the same exercise. Let's give it a quick look. Right, here's US 30 on the same daily time frame. Let's give it a look, right? US 30 absolutely dominated the markets, right? All the way to the start or the middle of 2021. From 2021, we saw a massive sideways move, and over 2020 was the worst year in the markets for quite a number of years. So have a look at the difference here. Worst year of the markets in many years. This is the dollar index. So this is currently just looking at 2022. But if you have a look at the dollar index, what does that look like? That's the best year in the dollar index in the last couple years. So you could reason that raising interest rates definitely has benefited the dollar, definitely has not benefited the stock markets. So that's the summary that you need to understand. But where are we now? Say, Dane, all this is great. Thank you for the information. Whatever the case may be, who cares? What does that mean now? Well, where we are now from an interest rate increase, right, and from a trend perspective, this is the first time that Powell is expected to give a 25 basis point hike, right? Previously, it was 50s. We skipped January's meeting because, again, they take a break for December. This is the first meeting we were expecting to see a 25 basis point hike. What does that mean? What does it mean for the Federal Reserve to reduce their rates of interest and not keep hiking it any further? The first thing is, it's two things. The first thing is they're seeing enough signs that inflation has either come to a peak or it's starting to round out, or that they're starting to see the signs or the fruits of all the actions they've put into place. All these monetary policies are in place to curb inflation. So if they're starting to see that, they can let off the gas a bit. Because again, remember, too tight of monetary policy essentially will push them into a recession. That's the first thing. The second thing is that tightening too hard will push them into recession. So it's a bit of a fear game where they're starting to see the results. They want to take their foot off the gas. right? But they also wary that they're going to essentially strangle the economy, right? The other issue is if they take their foot off the gas too early, right, that they won't achieve the monetary objectives that they've set out to achieve. So this is why essentially the 25 basis points in theory should be good for stock markets, should be bad for the dollar. Investors are waiting to hear that the Federal Reserve, which has eyes over the whole US economy, is going to say, hey, things are looking good, right? The economy is looking good. We're going to take our foot off the gas. There's lights at the end of the tunnel, guys. Don't worry. This is what the economy is looking for. Investors are looking for. However, this is not the same for citizens, right? Because if you guys remember the September interest rate announcement, it's just as simple where Powell said, hey, you know, to get the economy to shrink, we need unemployment to raise. We need unemployment higher at 4.4%, right? And people are like, what's going on? You know, this is the Federal Reserve in charge of this country's currency saying they need unemployment to rise to curb inflation. How does that work? This is part of steering and governing an economy. And this is why it's super important to listen in on these calls, to listen in on these speeches so you can just unlock your mind. And specifically as a trader, it's not as simple as just strategy. It's not as simple as just what we looked at this afternoon. Sometimes you have to put in the time and the effort to understand what's busy happening, and you'll be better for it. You'll be better for understanding how money works, how it affects your pockets, so on and so forth. Now, for those of you have variable credit, right? Raising interest rates means that you end up paying more and more for credit that doesn't have fixed interest rates. When interest rates increase, so does your repayments. So these are all things that affect you. Now, the difference is when you just have credits and this just hitting you, all you do is you get a notification from ABSA, FNB, Nedbank, whomever, saying, oh, your bond has gone up by X this month. Oh, your car's gone up by... But when you understand how this works and how to trade it, you're no longer in the passenger seat. You step into the driver's seat of an economy, you participate, you understand what's happening, and you can essentially offset a lot of those costs by using your brain and applying it to the markets. So again, the expectation this evening is that we're going to get that 25 basis point hike. Right now, how that's going to affect the economy, I have a fairly good idea of where we could end up going. Then I do think that the stock markets will react positively to that. However, as you guys saw with the Tesla earning call, that the initial data only is half the story. Actually, it's less than half the story. Why? Because markets have already priced in the expectation of the 25 basis point hike. What is more important to markets is not just the number, but it's the speech that Powell gives and the questions and how he answers them. Because 25%, again, is only half the story. As I said, it means one of a few things. Either he's scared of sending the economy into recession, or he's seeing signs that, you know, the economy is in a good space. But the question that everybody has is, how many more of these hikes are we going to see? And at what point will we see a reversal of interest rates? Okay. Now, there is one thing that I have found that I am very excited to share with you that is definitive, and it's proven in all of these recessionary cycles. And I want to show you this. Okay. Have a look here quickly behind me before we actually go through the interest rates. Okay. So first things first is that if we have a look at the end, right, of all of these cycles, right, let's have a look here. At the bottom of all of these rate cuts, right, let's have a look at December 2008 to January 2009. The interest rate bottomed out, meaning it could not go any lower. Have a look at what happens to the dollar when that happens. When the interest rate bottoms out, the dollar collapses, right? When the interest rate cannot go any lower, the dollar collapses. Again, having a look at that period, we can see here, December 2008, January 2009, the dollar starts to collapse. Let's have a look then at the coronavirus cycle or the pandemic. April, May 2020, right? Same story. April, May 2020, from that point on for the next year, the dollar was in a downward spiral. So that is definitive that when the interest rates bottom out, we are going to go into a spiral and the dollar will lose a ton of value. However, we're not there yet. But it does help us to look forward to something that could end up happening in the not too distant future. Now, a couple of things are going to happen this evening. First thing being, we are going to get the actual interest rate decision, right? And I just want to point this out. We're not going to have a lot of time to prepare for this, from a trade perspective. However, I do want to tell you not to worry about the initial spike, right? For a couple reasons. I've gone back into the data and I've gone through, listen, this was this afternoon's trade. If you guys are part of this afternoon's trade and strategy, just first and foremost, well done. You're an absolute machine. We absolutely smashed it across the board. It was an absolutely amazing one. But anyway, we're not here to talk about this afternoon strategy. Hopefully everybody is in good profit. I'm still sailing deep, $15,000 plus in the green there. But I just want to rewind a little bit, and I want to show you guys real quickly what sort of data I picked up here. So I'm going to a 30-minute time frame, and I want to show you why it's not important to worry about the initial spike. So we're going back all the way to July 26th. Let's just have a look here. Right, July. Let's see over here, July 27th, 2022. Right, at this point here, there was a 2.5% total, so 250 points. It was previously 250 points. It meets expectation, and still on that data, markets rallied 5,200 pips here. But I want you to also just understand here, the initial release at 9 o'clock only constituted for maybe around about a small fraction of that, about 1,300 pips. And then when Powell's speech came in, there was a massive rally there on after. Now, again, the next interest rate after that, let's just have a look here into September. There we go. We see here a 3.25, right, which was a 75 basis point hike, right? And again, here we saw massive sideways action, ultimately resulting in markets selling off. This is having a look at US 30, apologies. US 30, markets selling off for well over 9,500 pips. However, it didn't happen immediately. The little bit of sideways action, and then when Powell spoke, that's when the ultimate reaction ended up happening. I just want to go back because I do believe there was some more. I really went back quite a bit in time here, and I just want to make sure. There we go. So quite a bit, right? We've gone quite a bit into the past. I went through a ton of interest rate announcements, almost 2 years worth, and the one thing was consistent is that the initial move doesn't matter as much, right? Have a look here. On the 4th of May 2022, initial announcement happens. Not much happens. Powell speaks, and then 10,000 pips rally toward the top side. Okay, so we are going to set that up together. There's nothing for you to worry about. Nothing you have to jump in onto. In the perfect world, we'll set up pending orders. But again, even because of the fact that we initially get that little bit of volatility, you don't want a pending order acting or reacting on the first initial bit of news there, right? Example here. Let's have a look here on 21st on. Let's have a look here. 21st September, right? Again, 75 basis point change. I think we just read this one really quickly. Sideways movement, and then the markets ended up selling off 9,500 pips towards the downside. Right, having a look here at the 2nd of November. Now, this was quite a big one, right? Markets came in with their data literally at 8 o'clock in the evening. Interest rate was announced, and then we got on Powell's speech, initially spiked up 6,000 pips, and then ultimately sold off 13,000 pips, my people. 13,000 pips. So again, we're not worried about the initial movement. We know that markets have priced in have a look here. Markets have priced in a 0.25, a 25 basis point hike or percentage. What is going to matter the most this evening is going to be Powell's sentiment, Powell's speech. Everything that Powell says here is going to be the big one. Unless, there is a caveat here, unless we see a number that the markets did not expect. If we see a 50, so there we go. Data's out, it hits expectation exactly as the markets expected. Let's quickly go over to the price quickly. Price is remaining fairly unaffected. We're going to see some volatility. That's fine. No issues. But if you're still in your US30 sell, guys, you should be absolutely smiling right now. US30, nice, beautiful move there. I'll quickly show you my US30 on a 1 minute time frame. I don't mean to gloat or brag, but it is some beautiful stuff. You can't help whichever way you want to feel about it. It is what it is. Let me go through to 5 minutes. Oh, that's the dollar index. Dollar index originally acted positive to that. There we go. So there's USD. There's our sell from this afternoon. This is our exact setup from this afternoon for those of you guys who remember it. Right, we looked at that sell movement there. We looked at price breaking through there. We had about a 500 pip stop loss. Price moved down a ton, came back, didn't hit our stop loss, and then continued down towards the downside quite sharply. Okay, so again, the initial movement is going to happen, and then we're going to look at catching a breakout or change in market structure. Some sort of change in that momentum is where we want to end up going. So I'm going to go ahead, and the beautiful thing about our brand new platform is that I can right click here and I can close a portion of my trade, right? So behind my head over here, I can go ahead and close 75% of my position for the sell. So I can go ahead and go close, and there's 75% of my trade closed. I only have a 25 lot left after that close. So locking down $12,000 worth of profits and then sort of holding that out. So Keithon asking, do you send out signals? Family, I trade live. Signals are for people who are lazy and just want to sit there and do nothing. A, I trade live, but B, even better than a signal is essentially Gawain's asking, what does it mean for indices expectation met? So from my perspective, this should be positive for the markets, right? Meaning it's signaling, as I mentioned a little bit earlier, that the Fed is saying, hey, the economy is essentially coming back into order, that we are going to start to see the expectations being met from all the Federal Reserve's activity. However, right, based on previous moves, in most cases, markets sold off after the news, right? And so again, what Powell is going to say, right, what he's going to say in terms of his speech is going to mean everything here, right? The initial move, the initial 30 minutes, don't worry about it. It's going to be sideways market. It's going to be volatility. It's going to be people predicting what Powell's going to say, and that's almost impossible, right? So again, that's why generally before a big move, we would want to be in a trade. We want to stay in that trade all the way to the move, right? Because there's a possibility that our trade could be in the direction of the move. And then we have the earliest possible entry you can ask for, right? And that is what we're seeing happen here back this today. So if you trade with me live today, where we not only sold live, but put pending orders live in our sells, then again, you should be at this point in time. Let's just have a look here, running in plus minus 3,000 pips of profit already, just as it currently sits. Now, in essence, we need to wait for this to end up breaking, right? Having a look at what the dollar's trying to do, the dollar's trying to poke up a little bit forward. But again, this future of flattening interest rates should be negative for the dollar, right? Again, long term. Dollars performed on high interest rates. But again, should the interest rates start to taper off, the dollar should start to suffer. So what then could we see across other markets? Let's give it a quick look to gold. We don't want to neglect gold whatsoever. But again, should we start to see that weaker dollar, this is exactly where gold wants to be for a takeoff perspective or for continuation, right? Gold has been doing extremely well throughout as a safe haven currency. We're currently looking at 1 hour. I'm going to switch to a 4-hour time frame. Gold's been doing extremely well in terms of this bull momentum, but we've got into a little bit of a sideways market here. We made a push towards the downside. That was a liquidity grab there. It failed to sustain any movements below that support level. We're still riding above support. And now the next question is, will the dollar start to lose value? And if so, then we have massive buy opportunities on our hands for gold, right? Anywhere where the dollar is the quote currency, there's buy opportunities. If we look at NASDAQ is priced in the dollar. Gold is priced in the dollar. Silver is priced in the dollar. Bitcoin is priced in the dollar. So anywhere that we have dollar quote currencies, regardless if it's FX, whether it's a currency, whether it's a commodity, whether it's crypto, whether it's an indice, those are able to rally. When you understand how to trade, it doesn't matter what you trade. Again, you want to spend time with your instrument that you prefer, but someone asked, do I only trade indices? No, I trade indices because there's more volatility there and there's more price per pips. Doesn't mean there's the most opportunities there. I like the volume. I like the volatility. I've been in the space for a while. It may not be suited for you. You may want something that's a bit more trend worthy, that's a bit more consistent, that's less volatile. And then FX may be your pair of choice, or a commodity such as gold, or you may be more adventurous. You might like crude oil, WTI, whatever the case may be. But again, a stronger dollar this evening is going to be bad for indices, bad for commodities. A weaker dollar, which is not what we're seeing right now. We're seeing a stronger dollar. A weaker dollar would be good for indices. Now we're seeing that stronger dollar again, I think because markets and specifically big banks right now know that tapering off of interest rates is not going to be good for the dollar, specifically after these hours are met, right? And again, they're taking any advantage that they can at the moment before Powell's speech. My prediction, and again, everything I do here is for educational purposes only. This is not financial advice in any way, shape, or form, and past results are certainly not indicative of future profits. But my personal opinion is that we are going to see a little bit of a rally on the dollar up to the Federal Reserve interest rate discussion and speech. And once Powell starts to speak and essentially reasoning out his tapering, we could start to see a weakening dollar. However, if Powell is extremely aggressive, hawkish, right? And you can remember this by a hawk has got claws. Hawk is like a fierce predator. If Powell comes in extremely aggressive and says, we will do whatever it takes to, make sure all the tools we have at our disposal to, bring the economy into, control and whatever the case may be, and they want unemployment to go up, whatever. So hawkish, just take it as very aggressive. If he comes in very aggressive in his speech, right, the stock market is not going to like that. The dollar will like that, right? Domestic money will like that. They'll say, okay, our Federal Reserve is in control, we're safe, it'll boost the dollar's value. But if he comes in dovish, if he comes in saying, you know what, we're seeing good results and the economy is doing good and, we're starting to see all the data we want to see, that's dovish. Like if you look at a little dove on its side, like chilling, that's dovish. Soft, gentle, like, you see a dove, you don't fear for your life, you think, oh, there's a dove, nothing to worry about. You see a hawk, you protect your eyeballs. Same story. If you see a dove-ish approach, that's going to be good for stock markets, bad for the dollar. So it's going to come down to his speech. That's what it's going to come down to. His speech is going to be everything. So when we are streaming his speech, and again, provided the internet allows for that, if we're streaming his speech, I'll point out keywords, but watch my charts because I'm going to be trading that, right? So when I am looking at the charts, and my screen will look like this. When I open up my trading terminal here, right, there's the buy button, there's the sell button, and I will speak over him and I'll say, guys, I'm buying now or I'm selling. This is my plan, right? Normally speaking, we would put in pending orders around these events, but because of the volatility leading up to his discussion and because it's in two parts, it can be extremely difficult to trade in that manner. And we can see the indecision being reflected on the dollar right now. Big spike up, big pullback down. We're going to see that on US 32, right? Massive push down, a bit of a range, a bit of a push up. Ultimately, I believe it will be good for the market. So I'm going to go ahead and again, this is not the ideal range, but I would like to be in a buy at some point in this market. However, what I'm going to then do is rather look for price action, and I'm rather going to say, okay, if price breaks this level here, so if we start to trend, right, I'm going to go maybe down to a 5-minute time frame. If you guys want to follow me on the setup for US 30, I'm looking at this setup here and I'm saying, hey, if price breaks this level, I'm maybe just going to delete out this fib. Okay, if price is able to break through this level here, which will both be diagonal resistance, flat resistance in terms of just the supply demand zone, and obviously getting over that area over there, and a few other areas, if I'm honest, it's quite a decent zone. That constitutes for me a break in price, and I would then buy that. The reason I don't buy these small little push throughs like we see here, most people would get excited, and in this area, they would just start buying, right? If I show you in a 1-minute time frame, this is exactly what catches traders. A nice big push through, they drew some little baby structure like this, like, hey, look at that. They draw that, price goes through, grabs their order. It's just a liquidity grab, right? You need price to confirm, go through a structural level, show some sort of signs of continuation, some momentum, and then go through the top side. So as an example here, this is where a lot of traders get caught out. Price will poke through a level, right? Go back down, scare them, take out their stop losses if they have one. If they didn't have one, hopefully their orders the market would hope that hopefully their orders is essentially big enough to block or blow out their accounts. If it isn't, they'll either get scared and close, they'll take the loss, and then price will go back to their level and they go, oh, you see, I knew I should have gone there. They'll reopen, price will sink once again. How many of this have happened to you guys? Heinz says Dane must be sponsored by Dove. If this has happened to you, just put your hand up. Right, if this happened to you, price goes, it spikes through, you enter the order, it reverses on you, you get scared, closed, goes back to your order, you re-enter and it reverses again. If that's happened to you, it just means that the structural zone that you're looking at is too small, right? And you need to adapt your strategy to essentially have a more solid framework. Right? Because again, price will look at a bunch of traders where their orders are sitting, and big banks, big liquidity providers do that. Remember, they can see everybody's orders. So they see, okay, everybody's orders are here. There's a bunch of buyers here. There's a bunch of sellers here. And that's what market makers do, is they go and they activate all those orders. They grab a bunch of liquidity. They blow out those trades. They blow out those trades. And when they're free and they've created a bunch of liquidity, they're in a position then to run in the direction they want to go. Rizzy saying, not any more beautiful stuff. People putting up their hands, and it's just Naeem saying when fundamentals are broken. Absolutely. Fundamentals are broken. It's the first sign that makes me go, you know what? Let's stand back. But again, that's why we have Globex 360 Live TV, guys. It's not to glitz and glamour. It's not to send signals and be on Instagram and show you Gucci bags and arrive in shiny cars and say, hey, you know, just put $100 in an account and you can be a multimillionaire. It's about showing you the real stuff, the stuff that people don't want to talk about, the strategies people don't want to teach, right? So AK saying, when is the speech? The speech is at 9:30. So Powell generally speaks about half an hour after the data. Yeah, 100%. Okay, so the speech is coming up in the next 15 minutes, right? So we are going to do an Dane, we are on the way. Alvin's saying, Dane, we're on the way with Gucci with the J again. No, it's the Gucci with the capital P upside down inverted. It's still a G, right? A capital P upside down inverted. What is that? That's a B, isn't it? I don't know. Yeah, Alvin, you're picking up what I'm putting down. Thank you, family. Anyways, that's what it's all about. Wish Gucci. Okay, good stuff. Okay, there we go. Mark's got the hieroglyphics. Mark's got the sunglasses. I'm saying wish Gucci, wish.com Gucci. So you see that area there where most people would have entered a buy, right? That's what happens. Enter a buy and people scare. Fabian, you don't even have to ask me, not once, not twice, not even just, you don't even have to hint at it. Dancing Trump is there. He's just waiting for us to place a trade so we can go more than 500 pips in profit. Did we even use Dancing Trump this afternoon? Oh, we didn't. Oh, the stream got cut before everything fell through the floor. You guys must have been celebrating. I was driving home. I was looking at my MetaTrader. Don't tell anybody. I'll say you were lying. I wasn't driving and looking at my phone. Is Volky here? Volky's here. Yeah. Okay, yeah, Biden can't dance. He'll fall over if he tries. We'll have to get Biden with like a walking stick doing his thing. Okay, but anyway, so can you see here the initial volatility? It's almost sort of picture perfect from today's events, right? Everyone chases that initial rush, that, oh no, data's coming, it's positive, it's negative. Ignore that, right? Let the rush happen. What we care about is being long-term correct, not short-term right or wrong. Long-term correct. So that's what we're banking on. Okay, so what we're going to do, guys, let's just see here. Let's just see who jumped in here, who subscribed. Okay, before we carry on, let's check who the suspects are. When other people on YouTube, they're like, please subscribe. To be so nice. It'll be amazing. No, there's nothing like that here. I can see your names. Subscribe. One time. Like if you're here and you just watching like this, monitoring Spirit on the live broadcast, just subscribe, guys. You're going to get value. We taught a new strategy today. We milked the markets. Just do your thing. You know who's who, right? Joseph's asking, when are we getting app on iOS and Androids? Ish, that's a troubled one. Fire's asking, get Zoomer to dance. Go for them. Sub. Guys, smash the sub button. Smash the like button. We want to see at least I can see 164 people watching us live. Let's at least get the 164 likes for this live broadcast. I can promise you, if you haven't learned something already, you are going to, regardless, day in, day out, this is what we do. This is what it's all about. I am going to do a 5-minute intermission, right? Just so we can change up camera batteries, get some coffee going. Because again, when it comes down to the speech, I'm going to essentially warn what things we need to look out for. And again, what I'm going to do is after this, we are going to set up some pending orders. So I'm going to set up, so instead of saying, hey, buy now, sell now, I'm going to basically go, hey, above this level, I'm buying, and below this level, I'm selling. Very, very simple. I'll give you the levels. You can follow them on your side. But yes, I would really like to see a stock market rally, US 30 rally this evening. Markets over the past ton of interest rate announcements, right? The past 3 that we've seen, I'm just going to go back here. The past 3 that we've seen, December was a sell-off, right? Let's have a look here. Let's see, when is that? November, right, was a sell-off. Let's just have a look at the previous one. September was a sell-off. The previous ones to that were rallies, right? The only difference between these and the last ones is we're now starting to see that interest rate reduction, right? This is the first meaningful closer to 25 normality basis point hike that we would want to see. So I would like to see a redemption on the stock markets. I'd like to see a rally. I'd like to see a weaker dollar so we can go back to normal, right? So normal means Trump back on Instagram, on Twitter, doing his thing, Biden making his weird speeches. We'll get on with life. We can milk the markets, go back to where things are. But this absurdly strong dollar, these overly weak stock markets is obviously not a great thing. We have a couple people, some titans of industry, saying sell the markets. It's all going pear-shaped. Michael Burry from The Big Short, the movie, also probably better known for predicting the 2007-2008 housing crisis, says sell now, right? He posted a tweet 2 days ago. That's all he said, sell now. Now, is he saying sell now in light of the Federal Reserve speech? I don't know, right? While you have other people, titans of industry, saying, you know, there's a bull market coming in, you know, it's the best place to be, bull market's going to continue. So you've got titans of industry, right, that aren't necessarily, that are conflicting each other. So again, the best of the best don't know. What do we do when that happens? Price action's king. So what we're going to do, guys, is let's do a 5 minutes. You can see my camera saying it's time to go sleep. So we're going to do a 5 minute quickly and do a quick intermission. Smash the like button, leave a comment, tell us what you love the most, and tell us how your trading journey is going. If we get to 150 likes, we'll do something special. We'll give away something crazy. We'll pick some people just to shake it up a little bit and do some amazing things. So let's jump in it. Let's get it going. 5 minutes. I'll see you guys in a bit. Okay, beautiful stuff, guys. Okay, I just want to grab my coffee. Really quick one. This was a rush. We counted down to the second. Thank you, beautiful human. Okay, good stuff. I promise it's just coffee. Okay, so again, let's just go back quickly to why we don't want to trade the spike. In any event, as you can see, the interest rate announcement was pretty much dead flat, right? So if you're caught out in the hype, get caught out in some of that drama right there. Okay, so spike happened to downside, spike happened to the top side, pretty much sideways. So we missed the drama, right? It's just drama. There was no profit involved there. A bit of a scalping session. We're not in for that. We're in for the big move. So let me quickly show you the bigger plan here of what we aim to achieve this evening. Okay, so I'm going out into a 4-hour time frame, and I want you to see, this looks a little bit complicated, but there's a couple things, right? First things first is that there's a bigger structure at play, right? Second thing is I'm going to be giving away my charts, right? Meaning my chart setups, my setup for this whole analysis, right? Meaning everything I've done for both the current interest rate announcement and what you can use in terms of the CPI to the person who does the 120th like, right? So don't unlike and relike, but if you have to, I don't know, do that, whatever the case may be, to either the person does 120th like or the top 3 people who are our MVTs in the chat. So people who are hyping up the chat, doing your thing, keeping the love there, just let me know directly after this. I'm going to be sharing with you my full analysis, what I've spent hours and hours and hours on understanding the markets. There's reasoning, there's notes, there's price action, there's structure there. I will be sharing that with you. So whoever's the hype king and queens in the chat, I'll be giving that away absolutely free. And then again, we are going to be giving away $150 this evening as a credit towards your account. That's an equity boost. It'll allow you to trade bigger. It'll allow you to essentially spend more time in the markets. And we're going to give that out to the top 3 people in the chat, and you guys will vote for each other, right? So I'll call time for voting a little bit later. Please remind me if I do forget, if I do get a bit excited. But again, we're going to give away that $150 plus minus around about 2,500 Rand into your live accounts that you guys can take advantage of. Now, in any event, let's have a look at what we are busy doing here. Okay, so there's a couple structures. This is Dow Jones US 30 on a 30-minute time frame. We're going to trade this because it proves to be the most volatile when it comes to these interest rate announcements, right? Again, you are going to see there's going to be, NASDAQ can move. You're going to see gold can move. Whatever is your trade, you welcome, right? Again, as long as the dollar is going to be essentially the quote currency, then this would apply. If the dollar is the base currency, you have to invert your charts or work the opposite way around. Okay, so let's quickly have a look here, right? So what we're looking for this afternoon, or this evening rather, if we get a break in this price, we're looking at a pending order right below the previous low, right? So ideally here, we're looking at setting up some pending orders below, right, the 33,548 mark. Again, right, and this is going to be meaning we're breaking this smaller structure, and then again our bigger orders are going to be below this level over here, right? Again, on a 4-hour time frame, you can zoom out, and essentially that is where you want to be from a structural perspective. Price action, you want to break both that level, and then your bigger orders will be layered down here. Now again, this is quite a big move. That's 8,000 pips there, so we want to capitalize on the 8,000 down, and should we break this, it means all the way into Thursday, Friday, we can continue to benefit over the next 24 to 48 hours through a sell here. In adversely and oppositely, right, there's a very clean break here from a buy perspective, which is much closer to our levels, and that's going to mean a break of essentially this afternoon's session, which is right there. That's the 27th high, and then yesterday's high in the evenings. That's going to be the 34,100 level. I would like safely to get over the 34,200 level, right? So 34,200 is where I'm going to be adding some orders. Now I'm doing this in MetaTrader. Again, I would prefer to do this in our new trading platform, but I'm doing this in MetaTrader to obviously make sure that for those of you who are following, you can obviously take advantage of that. So we're doing a buy stop on the 34. I'm doing a buy stop. Again, this is not financial advice in any way, shape, or form. It's for educational purposes over the 34,200 level. right? So again, I'm choosing my order. It's a pending order. It is a buy stop, and that is going to be on the 34,200 level. I'm going to be looking at about a stop loss here of plus minus. I don't want to be going in extremely risky here. Now again, remember, this is a 4-hour time frame. So when you draw out some of your levels here, some of these stop losses are going to look fairly big, right? But in order to essentially catch a major spike here or long-term breakout, right, we're going to need to at least need about a 2,000 pip stop loss here. And that is going to read us down to the 33,990. Let's have a look here. Yeah, 33,990. 33,990, right, in terms of stop loss. Now remember, that is a 2,000 pip stop loss. Now again, we want to see in the region of 5 to 8, even 10,000 pips in a move here. But again, that's what it's going to take. Have a look at a previous move as an example. That was the move over there. This is a 4-hour time frame. The move happened and we saw a 17,000 pip over that period there. So definitely something we want to obviously look at. So again, buy stop at 34,200 with a stop loss on that 33,990 mark, right? So we're just catching in the buy stop there. Sell stop, we're going to catch below the structure. And again, there can be volatility here, so we don't want to get caught out too early. So what we want to do here is we want to set up a sell stop below support 1, support 2. That would register over there, right, as support 2 in that zone. And that's going to be the 33,540 mark. And I'm simply going to do a sell stop there as well. Pending order, sell stop. And that level is going to be that 33. I'm going to go for a 33,500. And again, we need to have a fairly healthy stop loss here, probably around about the 2,000 pips mark here. And I would need to then have a 33,700 stop loss. That would constitute for 2,000 pips. Now, the one important thing to do is we're going to drag these away for the time being, right? And we're going to drag them back up in a second there. So we've got those two sets up there, high and low, immediate market structure. Let's have a look what we're doing here. It definitely looks like markets want to break, continue further down. So what we're going to do is we're just going to wait for the speech to start. And I'm quickly going to grab that speech there. And the sell from this afternoon session is continuing. So if you want to get on that sell, it's starting to break a little bit of market structure. I'll enter, I don't know if I want to enter a smaller one here. I do want to wait for Powell to continue. But let's see here. I'll maybe add in a 20 lot position here, just down below, place my trade above market structure. So I'm just adding to my position that I already have in terms of that, but I've already got a position in profits. Just bear in mind that I'm trading with a trade already in profits. I'm selling at that point there. And if you're selling with me, you shouldn't be in about 500 or 600 pips already, right, towards the downside. So we're just going to place some alerts here really quickly. And I'm going to go ahead and quickly find that Powell speech. And the big goal here is to see if we can stream it this evening. I'm a little bit late to the speech itself. And the big question is if we're going to be able to stream it.
Workforce participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging,
so what we want to do here is just manage your risk here and just move your stop loss into profit. Alternatively, you can utilize a trailing stop
longer-term inflation expectations appear to remain well anchored,
1,000,
as reflected in a broad range of surveys of
trailing
households,
stop,
businesses,
10,000
and
points.
forecasters, as well as measures from financial markets.
And that'll drag
But
your
that's
trailing
not
stop
grounds
as
for
markets continue
complacency.
to sell.
Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues,
So we
the greater the
listening
chance
to
that
everything he has to
expectations
say.
of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
So at this point, you can choose to close at entry, or you can hold out, or just take some profit.
The committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price
He definitely
stability
seems
goals.
dovish.
Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
Okay, so I'm holding in that buy there.
It is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Just moving my stop loss into entry.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting
moving
back
stop loss to
to
entries.
services, and shortages have been abated. So you see that in the housing services sector, we expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story.
Okay, we're now running 1,500
The
pips
issue
in
is that we
profits.
have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your I'm sorry.
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
I'm going to be updating my trailing stop
Chair Powell,
to
Neil Irwin
be
with Axios.
5,000
You and
points.
some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS
Sorry,
this
I'm gonna make
morning.
that 7,000
job openings
points.
actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the
Making
data,
it,
of course.
10,000 points.
We've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, quits are
All
still at an
index is
elevated
falling
level.
with
So
the
many
dovish
indicators,
responses from Powell.
the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward?
And
Or
gold
does
benefiting
ongoing
from
now
that
mean
weaker dollar.
more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5
Just
and
keeping my stop loss
5.25%.
safe above my entry.
At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that
There's a little bit of a delay on MetaTrader. If you're on mobile, you should be good.
If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in in the other direction, then we'll make data-dependent decisions.
Beautiful. We're running
at
well
coming
over
meetings, of course.
2,000 pips
Quick
per
follow-up.
position
How are
there.
you viewing the kind of balance of risk
So that's
between those
a
two
good run right
options
there,
of,
ladies and
you
gentlemen.
know, the likelihood of maybe falling short of that or
Where's
going
Trump
beyond
at?
that level?
Do his thing.
I guess I would say it this way. I continue to think that it's very difficult to manage the
Meditated
risk
is just
of
stalling
doing
out ever so
too
slightly.
little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in.
So you can go
And
ahead and
now
lock in some
you
profits.
really do worry
You
about
can maybe take
expectations
1,000
getting,
pips, take
unanchored
a
and
position
that
out
kind
to
of thing.
2,000
This is a
pips,
very
up to you.
difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector. And they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, that this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent, we'll see more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria?
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Debt ceiling problem.
Gina and then Steve.
Guys, I'm just going to pause the background there for a second because I want to talk about this really quickly. Okay, we do need to hear
Ray
this.
Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So, the committee, obviously, did not see this as a time to pause. We judged that the appropriate, thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry.
Hey guys, really quickly, won't you guys quickly all just vote who's the MVTs in the chats, who deserves the $150? Just vote, give a name, do the vote quickly. I will check that, and then I'll ask that person to inbox me with the MT4 number. We'll go ahead and credit your accounts. When you wake up tomorrow, you'll have $150 credit towards your equity within your Globex 360 live account. You do need to have a Globex 360 live account. So if you don't, where have you been? Right, where have you been? So go ahead and vote now. Just tag somebody who you think you don't tag yourself. We don't do that in the Globex 360 family. Go tag somebody, and let's see who gets the tags. And remember, top 3 people, $150 credit towards your Globex 360 live account equity. Just go ahead and do that. And just before we wrap up, I just want to remember that one.
The inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases.
Okay, so it's definitely Fabian's getting one of them. So Fabian takes one of them. Fabian, you know the deal. You've got my Telegram handle. Just send us your MT4 number, my brother. Let's get you credited.
Thanks.
So a couple things. First, on the forecast, if you
Heinrich, I've seen Heinrich pop up multiple times. Heinrich, I hope you have a Globex 360 live account. I hope it's funded. Go ahead and send me your MT4 number down below. We'll get you credited. There's one more person left. Guys, let's vote. Fabian's taken it. Heinrich's taken it. Looking for one more person. You can vote one more person to give that $150 credit to.
And that goods inflation will move up fairly soon, back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand.
Hey, John,
and
before you go,
hard supply
the team
constraints,
is
not
voting
something
for
that
you, so you're the
really
third
have
winner there.
seen in prior,
We'll credit your account for
in prior
$150.
business cycles.
So
And so
that'll
now we
on its
see
way
goods
to you.
inflation coming down
Just go and
for the
send
reasons
in
we thought.
that
And,
MT4 number. I might give away
we
one more, so
understand
you
why
guys can
housing
continue
inflation will
voting.
come
Share
down.
the
I
love.
think a
Share
story
the
will
love. Share the love.
emerge
Share the love.
on the
Let's do this.
non-housing service.
The next person who shares their screenshot of profits, if they're in that buy, the next person to share their screenshot, my Telegram link is down below. Pop me a screenshot of that buy in profits, and we'll give you that $150 credit towards your live accounts. Let's go.
No one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than I expect to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening
AK,
not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023, and the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. We're not, market participants have a very different job. And it's a fine job. It's a great job. I did that job for years, but in one form or another. But, we have to deliver that. And so we are strongly resolved that we will, complete this task because we think it has benefits that will, support economic activity and benefit the public for many, many years.
Edward. Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible?
My 34-100 is activated, and it is absolutely pushing through that level. Right. So again, guys, listen, just a quick shout out. Everybody that's still in their Tesla trades, check out your Tesla trades we took last week. Check Tesla's share price. Tesla share price in $182, guys. We entered this thing 158, 182. That's over almost $30 on their share price. You guys are absolutely killing it. Anyway, sorry. Get back to the
into the somewhere in the mid threes or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Hi, Chair Powell. Scott Horsey from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time. But we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral, and I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem. That means that effectively, in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this, and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient. And people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation. And as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and, high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses that essentially. We believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. In this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if
Hey,
the
welcome,
Fed...
fam. I can see Temba Lusu has jumped in and become a member, an MVT. Temba, welcome to the Globex 360 family. Welcome. Becoming a member means you've jumped in. You're a supporter of the channel. Just welcome to the family. You're absolutely amazing. If you haven't yet already, guys, go smash the like and subscribe button. You know what it's all about.
And I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Good stuff. Amazing human beings. Okay, let's dive into it. Let's quickly break it down. What has happened? What has this all been about? What has just taken place? Okay, so we're going to break it down really quickly. So as you guys heard, if you've been part of previous speeches, you know that Powell can be pretty aggressive. Salem Dajij, welcome to the family. Thank you for subscribing. So again, if you guys have heard previous Powell speeches, you know he can be super aggressive, tackle the thing, hit the nail on the head. He was extremely relaxed this afternoon. This was a very dovish approach, and this is what the markets have been looking for. So I think two things. A, we can contribute, a little bit of this evening's movements to a reduction in rates. He was firm. He didn't beat around the bush. He said, hey, there's still quite a long way to go before we see the economy in a position, and some of the key indicators that we need in order to start looking at reducing rates, right? So again, he said, hey, the federal funds target is still well way off what the target needs to be, and there will still be some hikes. But I think it's safe to say that 25 basis points is going to be the temporary way forward, right? We might see one, if not two, worst case 3 more before we see a plateau in rate hikes and then a little bit of reduction. But in terms of what we were thinking about from a theory perspective, it has been positive for the markets. Initially, remember I said we'd see an initial bit of dollar strength up to his speech. Once his speech kicks in, if you guys remember, I say then we'll start to see that weakness unless there's something crazy that he says. So he came in on dovish tone. Let's have a look at what happened, what that translates to from a markets perspective. Let's quickly have a look at that dollar index in terms of what ended up happening there. So I'm going to quickly go down to a 1 minute time frame. I will share my screen with you guys in a second, but let me just show you really quickly how it kicked off for this evening. We'll go back to markets. Please don't worry about markets moving. Markets will move a bit. Again, as I said, lock in some profits, secure your stop losses, do whatever you've got to do there. We are pushing through a resistance level. So any sort of retracement, just don't worry about that. Just let it do what it needs to do. It is what it is. So maybe let me just start with that in case anybody's worrying and or stressing. So what we need to understand is that we've pushed through a barrier, right? If you have a look at this barrier here, this resistance level, we've popped through that, popped through resistance 1, smashed through resistance number 2, and now we're busy with a retracement. This is on a 4-hour time frame. If we go to a 1, you're going to see that little bit of rejection. It looks like a candlestick, it looks like a pin bar is pulling back, but you'll see on a 15-minute time frame what's actually happened here. We've pushed through, we're busy coming back to retest that lower zone, right? Again, I mentioned that 3430, right, 34030 is a safer level from a stop loss perspective, and that's only for the reason that if we look to the left here, we're going to see that 3430 resistance zone right there, right? So my safe zone that I would say from a stop loss perspective, my stop losses are lower than that, but if you don't want to risk all too much, you want to catch a good zone, that 34 34040, 34030 is kind of where you want to be. But I just want to point out on a 5-minute time frame, you can see we've popped through, we've smashed through those resistance levels. We made a little dive down into that retest zone, and that is natural, that's normal, right? Inexperience or just fear of the markets, any sort of move like that would scare people, close their trades. They'd want to get out of their long positions, whatever the case may be. Again, put a stop loss where your stop loss needs to be, not where you want it to be, right? It needs to be in a place that's safe, that if the markets break that level, it constitutes a break in structure. Then you don't want to be in the trade. Don't put it just in a place that makes you feel safe, because it's better. Right, I'm not saying it's better than not to use a stop loss, because you always have to use a stop loss, but put it where it needs to be, not where you just want it to be. That's important to state, right? So a push through, a retest back into structural levels is perfectly normal. That's how markets move. Markets don't move in a straight trajectory. There's impulses and retracements. We've had the impulse. Market's going to interpret the data, understand what Powell said. You'll see news publications, depending how they report it, say, Powell was quite polite, and they're going to highlight. And remember, big news, right? If you look at who owns big news, big media, right? Wall Street owns big news, big media, right? Most of the big news outlet is owned by Wall Street. If you don't believe me, go and Google it. Right, big banks own the media outlets. So how do the big banks create liquidity? They listen to a speech, they highlight just what is appropriate to them to create liquidity. They won't do a speech, or you won't hear a speech, then they report the facts. They won't say, yeah, Powell was actually optimistic about the future, he was this, he was that. They won't say that. They say, Powell says, troubling times ahead. Watch the news in the next day or so. You're going to hear just these highlights of what is appropriate to them to cause liquidity, fear, sell off, and then markets will go in their true direction. That's the importance of hearing and listening to the speeches, because I've actually never heard a speech where it's been reported in the correct manner, where it's captured the full tone, the full essence of what is attempted to be communicated. So at the end of a session like that, a little bit of sideways movement, no problem. Secure your profit. And again, this is what I love about our new trading platform, right? Is the ability, and I'm going to quickly show you this, to be able to close out a portion of your trade. So if I have a look here, right, there's maybe, one of my buys. I closed out my earlier buy, the big buy. I took my profit there. But if you right click on any of these trades, right, so you right click on any of your positions on the thing there, you can actually close, you can have a break even exit, meaning your system will automatically close at break even. But what I'm talking about is a partial close. So you can be in a position on a runner that has good profits, you can close 50, 60, 75% of that position, secure, lock down the profits, and then move your stop loss to break even on the smaller position that's left over, right? So it's just better risk management overall. But regardless, I'm going to leave this one in place. I've got some stop losses. I've banked most of my money ready to the top side. We had a good session towards the downside. This afternoon, we sold out off of the New York Stock Exchange. We sold out off the fundamentals. Nice, strong move towards the downside. Closed up those profits, made money to the top side, closed up some of those profits. And now I've just got a trade that if market structure continues to move to the top side, we're going to bank in some of those profits. If you're scared and worried, you can close out your position. As long as you made some money on the top side, you're good. If you made some money in the downside on the dollars for lunch session, you're good. As long as you've learned something, that is the most important thing, right? Opportunities happen every single day. If you're not learning and growing as a trader, it doesn't matter if you make a profit now or later. You're not going to maintain that. You're not going to keep it long term, right? So again, as we said, in the markets, a little bit of that temporary dollar strength, we got that as the as the rates came out. Let me just show you guys that. So I believe it was there. There we go. Let's just get to it. Sorry, my chart's trying to do some weird updates here. Okay, so there we go, 9 o'clock. We started to get that little bit of a push to the top side, an attempt to the top side. As Powell started speaking, rates dropped, as we ideally said it might end up happening, right? So that's essentially the summary. Dovish approach should be good long-term for the stock market, should be what the markets need in order to have that continuation towards the top side. But again, we need to see if it continues to honor the bigger market structure at play. Again, remember, we've pushed through this last area here. We may well retest it. Ultimately, we want to see, is that going to be a continuation towards the top side? Again, that's what it's about. We want to continue to hold this one. We want to make money on the short move and then see how we can obviously push towards the top side. So guys, it is late. We've been streaming for almost 2 hours as of this point in time. Again, as long as you've locked in profits for dollars for lunch, as long as you've locked in this impulse 3000 towards the top side, then you have learned something. If you haven't done so already, you don't have a Globex 360 account, where have you been and what are you doing? Hit the link down below. My Telegram link is down below if you wish to message me. The fourth person, I don't know who we are going to pick there, but we will find somebody. Battery is low, and that means it's time for you know what. Guys, remember to live, learn, and trade the Globex 360 way. Get those accounts open. I will see you guys tomorrow morning. Pounds for breakfast. We'll be doing dollars for lunch as well. And remember, it is the Meta earnings report coming out in the next few minutes, in the next 45 or so. So if you want to go ahead and look after that, I will send the link into the group. You guys know the deal. Read the report, look at the headline data, and see if you're going to take advantage of that potentially on the NASDAQ this evening. Guys, other than that, you know the drill. Have yourselves an amazing evening. Thank you to every single person that joined us this evening, for all the MBTs, all of our clients, all of our friends, all of our family right here, because that's what it's all about. I will see you guys all tomorrow. And until then, much love and goodbye.